Hi, this is Matt from Fairway Mortgage. This video is going over down payment, minimum down payment requirements, and also mortgage insurance. Mortgage insurance is what you pay for not putting 20% down. Different programs have different minimum down payment requirements, and they also charge mortgage insurance in different ways. So, out of the four main loan types, FHA, VA, conventional, and USDA, FHA has a minimum down payment of 3.5%. VA has a minimum down payment of 0. It allows for 100% financing, but you have to be VA eligible. Conventional, if you're a first-time buyer, it's 3%. If you're not, it's 5%. There's some cases you could do 3 even if you're not a first-time buyer, but in most cases it is 5 if you've owned a house in the past. USDA also requires 0 down, but you have to be buying in a USDA eligible area. So what this means in putting numbers with these, a purchase price with these numbers to give you a more accurate picture. At $325,000 purchase price, FHA requires 3.5 down. In this case, it's $11,375. VA is 0. Conventional is $9,750. USDA is also 0. Now, I'm going to quickly touch on this, but people say, well, what about down payment assistance? Yes, down payment assistance can help cover this or cover all of it. But it's important to know down payment assistance programs are based on these loans. For example, if you have a CHFA loan, there is a CHFA FHA loan. There's a CHFA conventional loan. There's a CHFA USDA loan. I'll get more into down payment assistance in another video, but just to cover that quickly, that is more information on that. Okay, mortgage insurance. Mortgage insurance is what you pay for not putting 20% down. So let's say in those examples, on an FHA loan, if you put 3.5 down, or a conventional loan, if you put 3% down, you have to pay mortgage insurance in some form because it is more risk. On an FHA loan, there are 2 ways this is charged. One is upfront mortgage insurance premium. It's called UFMIP. It's a 1.75% fee rolled into the loan. There is also monthly mortgage insurance that is at 0.85% monthly if you're putting less than 5% down. If you're putting more than 5%, it's 0.80. And if your loan amount is over $625, there's an extra fee. But for most people, it's 0.85. VA, there is not a monthly fee, but there is something called a funding fee. This depends on your eligibility and how many times you've used the loan. It is possible to be exempt from the funding fee. First time use is generally 2.3%. Second time use is generally 3.6%. That, again, that's a one-time fee. It's rolled into the loan. You don't pay anything monthly. Conventional loans. If you pay over 20% down, there is no monthly mortgage insurance and there is no upfront fee. So for somebody with very high credit scores, most of the time, a conventional loan is the best deal. Then monthly mortgage insurance depends on the amount of risk you are for a conventional loan. The risk factors, the major ones, are how much you're putting down and credit score. And credit score has a huge impact when it comes to monthly mortgage insurance for a conventional loan. So, for example, it can range. If you're putting 3% down, let's say somebody had a 660 score. It could be as high as 1.62%. If they've got a 760 score, it could be as low as 0.38%. I've seen it lower than that even. So there's a large range. The purpose of showing this is, one of the purposes is that when somebody looks online and they see a base mortgage rate, let's say they look up and they see FHA rate 4%, and they see conventional rate, let's say 4.3%, and the person is putting the minimum amount down, that is not showing the complete picture because this amount will be added to the rate. USDA. USDA charges a 1% fee, similar to the FHA 1.75. It's rolled into the loan. In most cases, you can pay it up front, but most cases it's rolled into the loan. And monthly mortgage insurance is 0.35. So it's a great deal. The issue with USDA is you have to be in a USDA eligible area, and the amount they let you borrow is the least, and there are income restrictions. So that's kind of an overview of down payment and mortgage insurance. To get accurate numbers, and here's real numbers associated with the purchase price we said before of $325. You can see you're paying an extra $5,911 if you're using an FHA loan. If you're using a conventional loan, you don't pay that amount, but you have to be able to qualify for it. And monthly, 0.85 is $243 a month. On conventional, if somebody had high credit scores, they're paying less per month, but if they had very low scores, they could be paying more. So as you can see, there's a lot of factors. Having a one-on-one meeting and seeing where you stand is very important if you're looking to get the best deal. Mortgage insurance or buying a house is confusing for everyone, even if they've bought a house 3 or 4 times. That's why we're here to help you better understand the options so you can make the best choice for yourself. Hope you're having a great day. If you have any questions, let me know. If you want to schedule a Zoom call, let me know, or we can talk on the phone, go over it.